Yes. Hi guys, how are you? What's up? I hope you all are doing very amazing. In this lecture, we are going to do a thorough revision of the entire chapter of how to raise finance from capital markets in just one lecture. So people, we are done with the sub-chapter of how to raise finance from capital markets. So it took us 5 lectures to complete that chapter. So the entire chapter will be revised in this one video of 45 minutes to 1 hour. Okay. So let's get started, people. Quickly tell me, what is the meaning of IPO, IPO, IPO? What is the meaning of IPO? IPO means initial public offer. When the company issues shares to the public for the first time is called as IPO. Okay. Now, what is the meaning of FPO? FPO means when the company subsequently issues shares to the public is called as FPO, that is further public offer. Okay. So people, we know that the company can go for an IPO in 2 ways. You either create new shares, you either issue new shares to the public, or you just sell them the existing shares to the public. So when the company sells the existing shares to the public, it is called as offer for sale. Okay. See people over here. IPO, 2 ways. Either you issue new shares to the public, or you just sell them the existing shares to the public. See people, example, do you remember Reliance? Let's say there are 3 shareholders, Mukesh Ambani, Anand Ambani and Bill Gates. Mukesh Ambani is holding 30 shares, Anand Ambani is holding 60 shares and Bill Gates is holding 10 shares. Right now the company has not gone public. Mukesh Ambani wants Reliance to go public and Bill Gates wants to exit this company. So Mukesh Ambani says, instead of issuing new shares to the public, Bill Gates, why don't you sell your existing shares to the public? So Bill Gates sells his 10 shares to the public and public pays Bill Gates money. So this type of arrangement is called as offer for sale, where no new shares are created. Okay. Now, who are the key players in an IPO? Let's quickly understand, people. Number 1 is issuer. The company that issues shares is called as issuer. Let's take that example as Zomato. Next is NSDL and CDSL. They are like banks. Okay, their job is to convert physical shares into electronic format and store them. Okay, so 2 types of banks are there. They are called as, first of all, depositories, NSDL and CDSL. What is the full form of NSDL? National Securities Depository Limited. And what is the full form of CDSL? Central Depository Services Limited. People, just 1 second. हो गया. Thank you. Yes. So until now we have understood 2 players. Number 1 is issuer, the company that is going for an IPO. And number 2 is depositories. They act like banks where they convert physical shares into electronic format and they store them. Okay. Next is people, NSE and BSE. They are basically market where investors buy and sell the shares. So there are 2 main markets, NSE and BSE. What is the full form of NSE, people? National Stock Exchange, and BSE is Bombay Stock Exchange. Okay. And next is investors. We know this. Now, what is the meaning of Demat account? Demat account is like a digital locker inside the banks. Demat account are like digital lockers inside the banks where investors store their all the shares in that digital locker. Okay. So Zomato issues all their shares to NSDL and CDSL. They are responsible for converting physical shares into electronic format. The moment investors buy and sell, Where do they buy and sell the shares? In the market. What is the meaning of market? NSE and BSE is the market. Now, once investors buy and sell the shares, where are they going to store their shares? They are going to store their shares in the demat account. Demat account is like a digital locker. Depository is like a bank. Inside it is digital locker. Investors buy and sell where? From the market. Very easy now, people. That's it. Okay. Now, let's quickly understand, when can a company think about an IPO? Basic eligibility conditions for a company to go for an IPO. When can a company even think about an IPO? Okay, so there are three sets of conditions. Number one is basic conditions. Number two is financial conditions, the heart of the chapter. And number three is other conditions. So right now, we are going to revise the basic conditions for a company to even think about an IPO. Okay, chalo. So we know there are two conditions with respect to default and fraud. Two conditions with respect to default and default or fraud. I have marked those in red color. Number one, issuer, the company that is going for an IPO. Promoter, the ones who have started the company. Director and the selling shareholder. What is the meaning of selling shareholder, people? If we talk about the offer for sale where Bill Gates is selling his shares to the public, who is the selling shareholder in this kind of arrangement? Bill Gates is the selling shareholder in this kind of arrangement. Okay. So, issuer, promoter, director, selling shareholder should not be barred by SEBI from accessing the capital markets. Number one, they should not even be involved with the people who have been barred by SEBI from accessing the capital markets. First, you should not be a fraudster. You should not even be involved with the fraudster. Okay, number one condition is done. Number two condition, promoter, issuer, director should not be a willful defaulter. They should not have intentionally defaulted in the repayment of, be it principal or interest. Okay. So two conditions with respect to default or fraud is done. Now let's talk about the obvious conditions. So four conditions are very, very obvious. Number one is approval from the stock exchange, where at least one stock exchange should have an in-principle approval, and the company should choose one stock exchange as the designated stock exchange. What is the meaning of designated stock exchange? That stock exchange which will be coordinating all the activities between the NSE and BSE and the issuer. Very easy, people. Okay. Next is agreement with the depository. Obviously, if the company is going to issue shares in electronic format, don't you think they have to enter into an agreement with the depository who are responsible to convert physical shares into electronic format? Okay. Next is, people, no partly paid up shares. Obviously, if you expect investors to pay full amount of money, you should first of all not have any partly paid up shares. If you have any partly paid up shares, you either cancel those shares or you convert them into fully paid up shares. Okay. Next is fourth, promoters must hold shares in demat format. Obviously, if you are expecting investors to hold shares in electronic format, the ones who have started the company, they should also hold their shares in electronic format. Very simple. Okay. So four conditions. 1, 2, 3, 4. And fifth is IPO issue period should be between 3 days to 10 days. IPO issue period should be between 3 days to 10 days. So very easy, people. So 1, 2, 3, 4, 5 conditions. 5 very, very basic, obvious conditions. Number one, IPO issue period should be between 3 days to 10 days. Next is approval from the stock exchange. You should choose at least one stock exchange to be a designated stock exchange. Next is you should enter into an agreement with the depository. Number 4, there should not be any partly paid up shares. If there are any, you either convert that into fully paid up shares or you cancel that. That's it. Very easy. Now let's talk about the 3 conditions, which is little difficult because numbers are involved and rates are involved. Okay. Number 1, minimum substitution should be 90%. Otherwise, you have to refund within 15 days. Company is going for an IPO, offer size is 100 crores. At least 90 crores should be subscribed by the public. If no, then you have to refund all the money back to the investors because you have not gained the trust of the investors. Very simple. Okay, next. If you are raising 100 crores from the public, you should use that money for the purpose of expansion, for the purpose which you have mentioned in the offer document. Okay. Now, if the company is not using that money towards expansion, towards diversification, most of the money they are using for general corporate purposes, for routine business activities, that is not allowed. So, SEBI says maximum 25% of the money you can use it for daily business operations. We don't have any problem, but not more than that. Okay. So maximum 25% limit is on general corporate purposes. Okay. Now let's talk about the most difficult conditions. This 75% of project finance, excluding internal accruals, excluding IPO proceeds, should have a firm backup, should have a firm commitment. Why? Because the company should not be entirely dependent on the IPO. Very easy. See. Okay. So Zomato requires 100 crores to purchase 1000 delivery vehicles. Zomato requires 100 crores to purchase 1000 delivery vehicles. Okay. Now 10 crores are already there in its bank account. 10 crores are already there in its bank account, which we call it as internal accruals. Then 30 crores it is planning to raise through IPO. 30 crores it is planning to raise through IPO. Next is 70 crores. That means what? 10 crores, 30 crores, 40 crores. So over here, sorry people, 60 crores it is. 60 crores. So out of these 60 crores, 75% of 60 crores should have a firm backup, should have a firm commitment, so that the company does not depend entirely on the IPO. 1 second, let's calculate this. Yes, it is 45 crores. 75% is 45 crores. So 45 crores company should have a firm backup, firm commitment. Okay. So our 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 conditions are done. 2 conditions are with respect to default or fraud. 5 conditions are very obvious conditions. 3 conditions are little difficult. Why? Because numbers are involved. Okay. Next. Now let's talk about the financial eligibility conditions for a company to go for an IPO. Very, very important topic, people. In your last attempt, this question was asked in your exam. Okay. So first condition, net tangible assets. Second condition is pre-tax average operating profit. Third condition is net worth. And fourth condition is name change. Let's understand quickly all of them. So number 1 condition, company should have net tangible assets of at least 3 crores in each of the last 3 preceding financial year. Okay. Out of that, less than 50% should be in monetary form. If at all the company has got more than 50% in monetary form, no problem. Company has to give a firm commitment to SEBI as to how are they going to use this excess money. Okay. Now, this 50% rule is not applicable if the company is going for an IPO through offer for sale basis. Why? Because no monetary transactions are involved. Is Reliance getting any money, people? Tell me. Where is this? Tell me. Is Mukesh Ambani, Anant Ambani, Reliance is getting any money? No. The money is going to Bill Gates. Yes or no? So if there is no monetary transactions involved, this 50% rule will not be applicable. I'm also telling you the logic behind why every single provision has been made. Okay. Chalo people. Now, next, second condition, minimum average pre-tax operating profit should be at least 15 crores. So when we take average, we take the best 3 years out of last 5 financial year whenever we take average. So we take 3 out of last 5 financial years best profit. Now, whenever we'll calculate the profit, we have to make sure that the profit is calculated based on 2 criteria. Number 1 criteria is restated basis. What is the meaning of restated basis? There should not be any valuation error. There should not be any defects. Now, what is the meaning of consolidated basis? If the holding company is going for an IPO, subsidiary company's financial results shall also be taken into consideration while we calculate the pre-tax average operating profit. Very easy, people. Okay. Chalo. Next is net worth. Company should have net worth of at least 1 crore in each 3 preceding financial year. Okay. Number 4th condition is very, very interesting. If the company has changed its name in the last 12 months, more than 50% of the revenue earned in the last year should be earned using the new name. If the company has changed its name in the last 12 months, 50% of revenue in the preceding financial year should be earned using the new name, so that investors don't get cheated. Very easy, people. So 4 conditions. Number 1 is net tangible assets. Number 2 is pre-tax average operating profit. Number 3 is net worth. And number 4 is name change. Very, very important condition, people. You have to learn it. You have to be by heart with this topic. Okay? Chalo. Now, even if the company has not complied with these 4 conditions, still the company can go for an IPO. How, sir? We are going to understand. So, they must allot 75% of the net offer to big players. What do you mean by big players? QIBs, qualified institutional buyers, banks, financial companies, insurance companies, pension funds, mutual funds. They are all called as QIBs. So 75% of the net offer should be given to them, and the price should be discovered using which mechanism? Book building mechanism. Book building mechanism. Yes or no, people? Logic is simple. If such big players are investing in this company, we don't have any problem even if we have not complied with the 4 conditions. The logic is very simple. Now, if the company is still not be able to comply with the QIB condition, that is 75% of net offer should be given to QIBs, they have to return all the money back to the investors within 15 days. Within 15 days. Simple, no, people? 4 financial conditions company has to follow, then only it can go for an IPO. Company has not followed the 4 financial conditions. Can the company still go for an IPO? Yes, provided the company allots 75% of the offer size to big players, QIBs, and the price at which the shares shall be allotted should be discovered using book building mechanism. If the company is not able to comply with this condition also, company has to refund all the money back to the investors. Now tell me, what is the meaning of book building mechanism? Book building mechanism is a method of discovering a price where all the shares are allotted at maximum price. All the shares are allotted at maximum price. Very easy. Okay. So now let's talk about the other conditions. So how many other conditions are there? 1, 2, 3, 4, 5. 5 other conditions are there. Sure. Let's get started, people. So first condition is company can issue convertible debt instruments even if they have not issued equity shares in an IPO. No problem. But the rule says you should not have defaulted in the repayment of be it principal or interest in the last 6 months. Very easy. You can issue convertible debt instruments, those type of debt instruments, bonds, debentures, which could be later converted into equity shares. Okay, you can issue convertible debt instruments in an IPO without first issuing equity shares, provided you should not have defaulted in the repayment of be it principal or interest in the last 6 months. Very easy. Next is minimum number of allottees. Very simple. At least should be 1000 allottees should be there. Okay. Next. No convertible securities. Company should not have any outstanding convertible securities that would entitle them to receive equity, that would entitle the holder of the convertible securities to get equity shares. Logic is simple. Company is going for an IPO. After IPO, investors will be there. Now, before IPO, those who have been issued convertible debt securities, if they convert their debt instruments into equity shares, suddenly number of equity shares will increase, because of which supply increases, then price will start to decrease. Now, if price start to decrease, it will not be in the favor of the people who have invested their money in an IPO. Yes or no, people? So, convertible securities. No IPO of outstanding warrants, convertible debt instruments, bonds, or any rights that will entitle anyone to receive equity shares after IPO. Very easy, people. Company says, SEBI says that if you are going for an IPO, you have to keep in mind that you don't have any outstanding convertible debt instruments that would later give the holders the right to convert their debt securities into equity shares. Whatever you want to do, you do it before IPO. If you want to convert that debt securities, you have to convert that before IPO. We don't have any problem. But after IPO, if these people convert their debt securities into equity shares, what will happen? Number of equity shares will suddenly start to increase the moment they convert their debt instruments into equity shares. And the moment equity shares numbers start to increases, supply increases and the price will fall, which will not be in favor of the allottees in an IPO. Yes or no? So you should not have any outstanding convertible debt securities. Easy, no, people? Okay. Next is IPO grading. Now let's take an example of Sennheiser. This company is going for an IPO. Now people like you and me don't know about this company at all, but we don't want to lose the opportunity to invest in this company. So Sennheiser appoints a credit rating agency so that they can verify this company. How are they going to use this proceeds of the IPO? Are they going to use it towards the right direction or wrong direction? Based on all the research, CRA, credit rating agency, will give them a grade. If the grade is A, that means company is worth going for an IPO. Investors should invest in this company. If the grade is very bad, that means company might not be able to use that money in the proper manner. So investors should not invest in this company. So any new company which wants to gain the trust of the investors during an IPO, they can appoint a credit rating agency, SEBI registered, so that they can grade them. They can prepare a report card of the IPO. Very easy. So IPO grading from one or more credit rating agency to assess the quality of the IPO so that investors can make informed decisions. Okay. Now, monitoring of IPO proceeds. If the size of the IPO is more than 100 crores, it's a very huge amount of money. Okay. So in that case, company can appoint a bank or a private financial institution. For what purpose? So that they can monitor how the company is using the money of the IPO, to check whether the company is using that money in the right manner or in the wrong manner, so that investors' interest could be saved. Investors' hard-earned money could be saved from going in the wrong direction. So they have to monitor utilization of proceeds and report to SEBI on a quarterly basis. on a quarterly basis. What is the meaning of quarterly basis? After every 3 months, they have to report to SEBI until 100% of the money has been utilized. So the moment a company raises 200 crores in an IPO, quickly they have to appoint a bank or a private financial institution so that these people can monitor how the company is using the IPO money. Every 3 months, they have to submit a report to SEBI as to this company has used this money for this purpose, that purpose, until they have used all those 200 crores they have received in an IPO. Simple, no, people? So 1, 2, 3, 4, 5 conditions we have understood. Number 1, company can issue convertible debt instruments provided they should not have defaulted in principal or interest in the last 6 months. Number 2, minimum number of allottees should be at least 1,000. Company should not have any outstanding convertible securities before it goes for an IPO. Whatever you want to do, you have to do it before the IPO. During an IPO, if you are doing this, it is not allowed. You either convert them or you don't go for an IPO. Simple. Next is IPO grading by one or more CRA. For what purpose? To assess the quality of the IPO. And last is monitoring of proceeds. If the IPO size exceeds 100 crores, company has to appoint a bank or a private financial institutions to monitor how the company is using the proceeds of the IPO until they have utilized 100% of the money on a quarterly basis. Very easy, people. That's it. Okay. Now, let's talk about the intermediaries. So, how many intermediaries are there, people? Merchant banker is there, registrar is there, underwriters are there, bankers to the issue are there, and syndicate members are there. Compliance officer is also there. So 1, 2, 3, 4, 5, 6. 6 intermediaries. Let's understand it. What is the role of a merchant banker? Merchant banker acts as a main guide of the entire IPO process. He coordinates with the other intermediaries. They also decide the price of the shares. They prepare all the legal and financial documents. And those merchant bankers can appoint other merchant bankers if the IPO size is too huge and it couldn't be managed by a one merchant banker. In that case, the main merchant banker can appoint other merchant banker also. While one merchant banker acts as a lead merchant banker, acts as a leader. Yes or no, people? Chalo. Next is merchant banker are also responsible to increase the awareness among the investors that Sennheiser is going for an IPO. So their job is also to promote the IPO. Yes or no, people? So 4 conditions. Number 1, main guide of the entire IPO process plus coordinating with other intermediaries. Number 2, they decide the price of the shares. Number 3, they prepare legal and financial documents. Number 4, they also promote the IPO. And in case they're appointing more merchant bankers, one merchant banker acts as a lead merchant banker. Very easy, people. That's it. Now, let's talk about the registrar. Registrar acts as an administrative manager in the IPO. Now, their job is to accept applications and ensure right number of shares are allotted. And in case there are any refund of shares in case of oversubscription, their job is to process the refund. And last is allocation of shares. Very easy. Next is, people, underwriter. Underwriter is very, very interesting. What is the meaning of underwriter? Underwriter, they are the guarantee providers in an IPO. In case the company is not able to sell all its shares, company is not able to allot all its shares, in that case, underwriter tells the company, don't worry, buddy, in case public do not purchase your shares, we will purchase all the leftover shares in an IPO. After a certain period of time, we will gradually sell them back the shares. Okay? So, underwriters acts as guarantee providers in an IPO. Number 2, they promise to buy leftover shares in the IPO that was not sold in the market so that later they can sell the shares gradually, slowly to the investors. Yes or no, people? Next is bankers to the issue. Now, what is the role of bankers to the issue? They are responsible for receiving money in an IPO from investors who obviously want to purchase shares in the IPO. Once bankers to the issue have received the money, once IPO is done, they will transfer the money back to the company. They will transfer the money back to the company. That's it. Next is people, syndicate member. Syndicate member job is very dry. They are only responsible for deciding the price during book building process. They also help in distribution of shares, help in the book building mechanism, help in the coordination so that IPO has been executed in a smooth manner. Okay. Compliance officer, whatever rules we are studying, okay, compliance officer job is to make sure company has followed, company has complied with the all rules. So monitor compliance with the security laws. So whatever we are studying right now, SEBI laws, they are basically security laws. They also address the complaints of the investors. So 6 intermediaries we have understood. Number 1 is merchant banker. Number 2 is registrar. Number 3 is underwriter. Number 4 is bankers to the issue. Number 5 is syndicate member. And number 6 is compliance officer. Very easy now, people. Are you able to recollect whatever we have studied in the last 5 to 6 lectures? Yes or no? Okay. See, people, example also I have shown you. Lenskart is issuing 100 new shares. Appoints an underwriter to purchase the remaining 20 shares. Why? Because public has only purchased 80 shares. So in that case, underwriter comes as a savior for the company. He says that in case public do not purchase your shares, don't worry, we will purchase your shares. Yes or no, people? That's it. Now, next, pricing in case of IPO of shares. How the price is set, people? 2 price discovery mechanism. Number 1 is fixed price mechanism and number 2 is book building mechanism. What is the meaning of fixed price mechanism? A specific price has been already decided by the company in the offer document. Investors have to purchase the shares with that price only, with that specific price only. Next is book building mechanism, where price band or a price range is provided because company does not know what is the value of their shares. So in that case, company gives a price band that our share might be between the range of 100 rupees to 500 rupees. Those who want to purchase the shares, they can submit the bids, but make sure the bid price is between 100 rupees to 500 rupees. Yes or no, people? So final price will be decided based on the investor demand. I already told you what is the meaning of book building mechanism. Book building mechanism is a method of discovering a price where all the shares are allotted at a maximum price, not specific price, at maximum price. That mechanism is called as book building mechanism. Very easy now, people. That's it. Next, if we talk about the debt instruments, coupon rate, conversion price. What is the meaning of coupon rate? They are basically interest rate which is set by the merchant banker. Okay, 15% debentures, 18% debentures, 10% bonds. What is the meaning of this? Basically, those bonds, those debentures carry interest rate of 15%, 8%, 10%. Yes or no? Now, if we talk about the conversion price, if the company issues convertible bonds, convertible debentures, convertible debt instruments of any type, so later those debentures, later those bonds can be converted into equity shares. So, price at which debentures or bonds are converted into equity shares are called as conversion price. So if we talk about debt instruments, coupon rate we have understood, basically it's an interest rate, and number 2 is conversion price, the price at which debentures, bonds can be later converted into equity shares. Yes or no? Next is offer document. So there are 3 types of offer document. Number 1 is fixed price, book building mechanism, red herring, prospectus. If we talk about book building mechanism, we already know price band is provided in the offer document. If we talk about red herring prospectus, floor price is mentioned. Now what is the meaning of floor price? Minimum price is mentioned, but maximum price has not been mentioned. We don't know what is the maximum price of the shares. So in that case, that type of price where only minimum price is provided, no maximum price, is called as floor price. Very easy, people. So offer document, there could be three types of pricing. Number one is fixed price mechanism. Number two is book building mechanism. And number three is floor price. Very easy. That's it. Next is, whenever the company is going for an IPO, company has to make sure that the issue price is always more than the face value. Issue price is always more than the face value. So we have understood how the price is set. We have understood debt instruments. We have understood offer document. We have also understood issue price. That's it. Now let's talk about differential pricing in IPO. Before that, let's take a break of 5 minutes. Okay, people? Chalo. Yes, people. So let's continue. So we were revising, the topic of differential pricing in IPO. The important question is, can shares be offered at different prices to the investors? Now this topic is going to answer that question. Number one, retail investors and employees can receive shares at a discount. Now what should be the maximum discount? 10% could be the maximum discount. Now what is the meaning of retail individual investors? Those investors who apply for shares, the maximum value is up to 2 lakh rupees, not more than that. If investors who are purchasing shares more than 2 lakh rupees, they will not be called as retail individual investors. They will be called as high net worth individuals or non-institutional investors. We are going to understand the meaning in the last topic. Okay. So let's understand this. Retail individual investors and employees can receive shares at a discount, but the maximum discount could be 10%, not more than that. Very easy. Okay. Now let's talk about the employees. Very, very similar. Employees can be offered shares at a price that is lower than the floor price if the company is issuing shares using the floor pricing mechanism. But how much lower? Same. Discount should be maximum 10% discount if the company is issuing shares using floor price mechanism. Yes or no? Now what is the meaning of alternate book building method? Alternate book building method is very simple. Normal book building method is for investors, but alternate book building mechanism is for the employees. That's it. Very easy, now people. So if the company is issuing shares using floor pricing mechanism, obviously the price will be discovered using book building process, alternate book building process. In that case, maximum discount that could be offered to employees will be 10%. That's it. Very easy. Now let's talk about anchor investors. What is the meaning of anchor investors? First of all, understand this. Anchor investors are a part of qualified institutional buyers. Anchor investors are big investors. Mutual funds, banks, financial institutions, insurance companies, pension funds, portfolio financial companies. So they are called as big investors, QIB. Okay. Among that, there are certain category of investor called as anchor investors. Okay. So among all the QIBs, there are certain investors called as anchor investors. What is the meaning of anchor investors? Anchor investors are those investors who receive shares before the company goes for an IPO. Why? So that initial demand could be created. Public's trust could be increased. Why? Because public's thinking would be very simple. If such big players are investing in this company before the company is going for an IPO, definitely the company could be worth investing. Yes or no? With that simple logic, company issues shares to the anchor investors before the company goes for an IPO. Now, does that mean anchor investors will receive any kind of discount? No, anchor investors will not be offered any kind of discount. So, anchor investors can be offered shares at a price, but not lower than the price that could be offered to other applicants. No discount to anchor investors. Very easy. See, people, large institutional investors who invest before the IPO opens to public in a book building mechanism. Now, who can be anchor investors? Mutual fund can be anchor investors. Insurance companies could be anchor investors. Pension funds could be anchor investors. That's it. Very easy. Okay. See, people, normal book building mechanism is for the public and alternate is for the employees. Very easy. So we are done with this. Now let's talk about the most important topic, and that is promoters' contribution. Okay. So what is the promoters' contribution, people? Minimum 20% of post-issue capital shall be brought by the promoters. Now what is the meaning of post-issue capital? Let's say in 2027, company has went for an IPO. So 2028 is the post-IPO period and 2026 is the pre-IPO period. So SEBI says post issue, whatever is the size of the company, the size of the company's 20% shall be brought in by the promoters. Very simple. Let's say before the company went for an IPO, the size of the company was 100 crores. Now IPO size is 100 crores. So now tell me, what is the total size of the company? 100 crores and 100 crores, 200 crores. So 200 crores, 20%, that is 40 crores shall be brought in by the promoters. This is what the rule is trying to say. Logic is simple. If you are raising so much money from the public, how much are you investing in this company? We want to know. If you are not investing in this company, that means it is 100% sure that you are not even going to use the public's money properly. So make sure that you put in your own money first, then you take money from the public. Logic is simple. So SEBI says minimum promoter's contribution should be 20% of post-issue capital. Yes or no, people? Now, once promoters have brought in money, for how long they cannot withdraw that money, we'll understand. There are two situations. If the company is using less than 50% of the IPO money towards capital projects, then 20% lock-in period will be only for 18 months or 1.5 years. But if the company is using more than 50% of the IPO money towards big projects, capital projects, where the time period of return will be very long, in that case, promoters have to stay invested for a long period of time. How long, people? 3 years. 3 years. Very simple. So lock-in period of the promoters. Two situations. Situation number one, company is using less than 50% of money towards capital projects. No problem. Return will take a short period of time. So promoters have to stay locked in for a period of only 18 months or 1.5 years. But if the company is using more than 50% of IPO money towards capital projects, big projects, which we know for sure, the time period of return will be very long. In that case, promoters have to stay invested in this company for how long? For 3 years. Now the important question is, this 18 months, 1.5 years or 3 years, from which date this time period will begin? The time period will begin from either the date of commencement of commercial production, the day company starts its business operation for which they have received money for the IPO, or the date on which shares will be allotted in the public. Whichever date is the later date, from that date onwards, the 1.5 years, 18 months or 3 years will start to begin. Yes or no, people? Very easy. If commencement of commercial production date is the later date, from that date onwards, 1.5 years or 18 months, day will start to begin, or 3 years. Okay. Now, in case the promoters have contributed 50 crores, 60 crores, instead of 40 crores, the additional excess 20 crores or 30 crores, that additional excess money will be locked in for a period of only 6 months, not 1.5 years or 3 years. Okay. Now, the most important part is no lock-in if the company is going for FPO. I told you what is the meaning of FPO? Further public offer. Subsequently, the company is issuing shares to the public. IPO is done. Now, after a few years, company again wants to raise finance. So again, they are going for public offer, public issue. So that subsequent offer is called as FPO, further public offer. Now, in case of further public offer, lock-in period will not be applied. Can you tell me why lock-in period will not be applied? The reason is, company has went for an IPO, investors have trusted them, company has followed all the rules and regulations. Now again the company is raising finance. So in that case, company has already stayed long enough in the capital markets. Investors are trusting the company, everybody is trusting the company. So in that case, lock-in period will not be applied. Lock-in period will not be applied for an FPO. FPO. Very easy, now, people. So this is promoter's contribution. Very important. Definitely this question will come in your exam. Okay. Chalo. Now let's talk about the last topic of this chapter. Before we dive on to the last topic of chapter as to how the shares will be allocated in IPO, let's first understand what are the three categories of investors. Number one is, people, retail individual investors. Number two is non-institutional investors. And number three is qualified institutional buyers. Now, what is the meaning of retail individual investors? People like you and me, common people who have applied for shares up to maximum 2 lakh rupees. They are called as retail individual investors. Job people or college student, businessman, middle class people, they are called as retail individual investors. They apply up to maximum 2 lakh rupees. They invest their personal money. They don't have any backup. Very easy. Now the second category of investors are high net worth individuals like Bill Gates, Mukesh Ambani, Warren Buffett, Steve Jobs. Steve Jobs is not there. But people who are very wealthy, who are very rich, they are called as high net worth individuals. So investors who invest more than 2 lakh rupees are called as non-institutional investors. Yes. They're also not institutional investors. They are not companies. They are individuals. Okay, people? So high net worth individuals, wealthy businessmen. Okay. Now, the third category of investors are qualified institutional buyers. They are big players. Mutual funds, bank, financial institutions, portfolio financial institutions, pension funds. So, 3 categories of investors. Retail individual investors, non-institutional investors, and number 3 is qualified institutional buyers. Now, let's understand how will the shares be allocated to them. So, there are people, 3 scenarios. Number 1 is book building method, general case. What do you mean by general case? General case is a situation where there is no excessive demand from QIBs. Okay, this is a general case, normal scenario. Second is special case where there is excessive demand from the QIBs. In that case, again the allotment rate will change. Next is company is not using book building mechanism. Company is using a fixed price mechanism. So in these 3 situations, let's understand how will the shares be allocated to the investors. Number 1, let's talk about general book building mechanism. So retail individual investors, people like you and me, should receive at least 35% of the shares. Company's IPO size is 100 shares. At least 35 shares should be given to retail individual investors. Next, non-institutional investors, Bill Gates, Warren Buffett, how much will they receive? At least 15% of shares they will receive. I am using the word at least in the 2 categories of investors. At least. Okay, people. Minimum they must receive this much amount of shares. Okay. Next is qualified institutional buyers. Over here, I am using the word maximum. Maximum 50% of shares must be allocated to qualified institutional buyers. Maximum 50% of shares must be allocated to qualified institutional buyers. Now, among those qualified institutional buyers, 5% shall go to mutual fund. 5% must go to mutual fund. Now, 5% of what, sir? 5% of the entire IPO size shall go to mutual funds. Okay. Now, anchor investors can also receive shares. Anchor investors may, I'm using the word may, that is optional, not mandatory. Anchor investors may receive shares, but how much maximum? 60% of the, is it IPO size? No, it is the QIB portion. 60% of QIB portion may be allocated to anchor investors. Yes or no, people? So if I talk about mutual funds, I'm using the word must, plus I'm also using the word IPO size. 5% of the IPO size will go to mutual funds. Mandatory. But over here, I'm using the word maybe and QIB portion. 60% of QIB portion may be allocated to anchor investors. Very easy, people. That's it. So general book building mechanism is done. Now let's talk about special case. In case there is excessive demand from QIBs. Now people, you tell me, if you are a company going for an IPO, you have got 2 categories of investors who are willing to buy your shares. Bank, financial institutions, and number 2 is normal people like you and me. To which person will you allocate the shares? Obviously, to the person who will stay invested for a long period of time, who will not change his or her decisions based on the emotions. Yes or no? So obviously, if there is excessive demand from the QIBs, in that case, QIB share will increase. So over here, 10% maximum will go to retail individual investors, but over here, at least 35 would go to retail individual investors. Next, at maximum, 15% will go to non-institutional investors, but over here, at least 15%. Rate is the same, wording is different. At least word is used, maximum word is used. Next, if we talk about QIBs, 75% at least must go to QIB. But over here, maximum 50% would go to QIB. Do you understand the difference? Are you able to understand why certain laws, certain rules has been made, people? Very easy, no, people? We are understanding every single law using logic. Okay? Now, 5% can go to mutual funds, and this is the same. Okay. Now let's talk about non-book building process allocation. If the company is issuing shares at a fixed price, at a specific price, in that case, at least 50% shall go to retail individual investors. At least 50% must go to retail individual investors. Over here, 10% maximum. Over here, 35% at least. Okay. Now, remaining shares can be allocated based on the proportion. Remaining shares can be allocated based on the proportion. We can give shares to non-institutional investor also and QIBs also, but at least 50% must go to retail people. That's it. Now, in case there is any unsubscribed portion, in case if not 50%, only 30%, 40% have been subscribed by the retail people, the excess can be given to QIB or non-institutional investors. That can be adjusted. Okay. That's it, people. We are done with the revision of the chapter of how to raise finance from the capital markets. Okay. This is how we are going to do a revision of the entire chapter in just one lecture, so that you'll be thorough with whatever we have studied in the last 5 to 6 lectures. Okay. So in case if you have got any doubt, just make sure to drop all your doubts. We will make sure that we will resolve all your doubts in less than 3 hours. Okay. Thank you so much for watching, people. It really means a lot that we have stayed so much while. Okay. Eat well, sleep well, study well. I will see you in the next one. Take care and bye-bye.